It's a great honor to have Mr. Hakimian here today for a quick interview. We're going to talk about economics and the markets. He is the founder of Tolou Capital Management. Mr. Hakimian, maybe tell us a little bit about yourself before we get to the markets.
Well, thank you very much for your time, Elias, and a little bit about myself. I started a macro risk parity hedge fund about 5 years ago. The premise of the fund was essentially that we were trying to mimic some stuff that long-short equity funds do, but while maintaining the returns that maybe the long-short funds in pursuit of lowering their risk, sometimes, historically you can see some of the data, they've missed some of that return. And long story short, when we looked through the long short funds, we basically found that one of the reasons for their potential underperformance, and not all of them, but the average one, was related to the fact that when you're long short, your hedging mechanism, aka the short side of your portfolio, it's really expensive. And it's let's say if equity markets go up 6 out of every 7 years, that means that 6 years your hedging mechanism delivered nothing. On the other end, so we tried to basically look at, would there be some type of way that you could mimic the safeness that those long short funds provide, especially in those down years, but not give up that much on the side of your returns.
Mm-hmm.
And basically what our research lended us to at the end was that if you were to invest in uncorrelated asset classes, and this is a big distinction because an asset class, and being short is not an asset class, obviously, it's just being short an asset class. But any asset class, independent of every other asset class, has a positive expected return. Otherwise, it couldn't be an asset class. No one would part from cash to invest in something that wouldn't yield them a positive return over whatever period it would be. So basically, what we found was, as long as you can create some balance of portfolio, composition through different asset classes that are uncorrelated, but regardless of their, the fact that they're not correlated, as long as each of them independently can have a positive return, you will still maintain a positive return. You'll do pretty much better than a long short fund would, and we went with it.
Okay, so the idea was, I guess, to have sort of the same risk, but offer your clients a higher return.
Exactly, and it would basically be that we didn't want clients to lose on the side of return just in the way of being less risky. I mean, you can even consider risk as, well, if you miss a bull market, there's a risk in that. I mean, if you miss a bull market in oil or in gold or in 2-year treasuries, there's a risk in that. There's obviously, everyone thinks of risk as being in the equity market when it collapses, and of course that is one of the most common risks, and we try to hedge that as well. But there are other types of risks that we believe that fund managers should try and protect against as well.
Absolutely. And when was your hedge fund founded?
2019.
2019. Okay. Thank you very much, Mr. Hakimian. We will cover 5 topics today, starting off with real yields. Then we will move on to gold, AI and earnings, US-China relations, and last but not least, we'll talk a little bit about diversification. So first of all, real yields. In November and December, financial conditions have loosened significantly in response to the Fed pivot. And obviously, the Fed was able to pivot because inflation has fallen so much. But that fall in inflation is, of course, also causing real yields to rise. So kind of taking into account the recent easing in financial conditions, how much do you think will real yields affect the US economy in 2024?
Yeah, that's a great question. Let's actually leave aside, nominal yields just for a moment. And you're correct in observing that they fell in November and December, and they've, picked back up a little bit in January, but they're still well below levels we've seen recently. Real yields right now, let's use the 10-year tip as an example. It's at 1.8%. That is inherently self-correcting. That basically means that we have a 10-year yield that is 1.8 full percentage points above the inflation rate that we're experiencing. And historically, every time that we've had a real yield that approaches 2%, the last time this has been we've even been near 2% has been in 2008. It eventually contracts economic activity. It eventually slows down inflation. It eventually leads to a rise in the unemployment rate. No matter how long it might take, it eventually will lead to that happening. And as that happens, the Federal Reserve can step in two ways. One way is they can step in just to recalibrate real yields. That could be the type of scenario where they might cut by 75 basis points this year, just to recalibrate the nominal yield versus the inflation rate. And then on the other side, you could have the type of example where inflation severely falls in a recession, and the Fed would have to really aggressively cut, because you cannot have a 4 or 5% 10-year yield in a world where inflation is 1%. That is just way too restrictive of a stance. So given the fact that economic activity is slowly but surely slowing down, and given the fact that right around this 2% level has historically in the US in the 21st century been, I don't want to call it the breaking point, but it's more or less been the maximum amount of real yields that our economy has been able to handle due to demographics, due to productivity growth, due to a lot of different variables. It just seems more likely than not to us that real yields will fall in the next year, 18 months, whenever it may be.
Okay. And as you know, the Federal Reserve, it seems to be that it is very focused on orchestrating that soft landing. So kind of taking that into account as well, do you think that the likelihood is high that it will cut interest rates to sort of recalibrate downwards and make sure that real yields don't become too restrictive?
First thing I'll say is I think, and they've made fantastic progress so far in their goal of achieving a soft landing, but nonetheless, I think a soft landing is very hard, just based on every single time we've passed a 5% inflation rate in the United States. It's always led to a recession to end. So can this time be different? Sure. Does this time look like it might be different so far? Possibly. I still will think the end of this will end in a recession. How severe it is, I mean, it'll remain to be unseen. And how severe it is will depend quite significantly on, will the Federal Reserve start cutting rates preemptively just to soften that real interest rate? Maybe they take the real interest rate to 1%. And that would be the type of scenario where, if it were to be a hard landing, maybe it would be less of a hard, maybe it would be a little bit less hard. Maybe there would be a little bit less of a default cycle. Maybe there would be a little bit less of a rise in the unemployment rate, a drop in corporate profits all around. But absolutely, I agree with you. If the Federal Reserve wants to engineer a soft landing, which I absolutely believe they want to, they've said from the start that's what they want to do, I believe it would be prudent to start cutting rates, not just to recalibrate that real interest rate.
Okay. And sort of from that perspective, is it premature for the markets to bet on 140 basis points of rate cuts in 2024?
Is it premature? I'm not sure. Markets are obviously forward-looking, and they're highly efficient. Markets really don't tend to misprice things so severely. Obviously, the Federal Reserve is, forecasting 75 basis points of cuts. The credit market, the Fed Fund overnight index swaps market was showing 150. Now, like you said, it's showing 140 basis points of cuts. Maybe that's just the credit market expecting a little bit more of economic contraction in the year ahead. And also, as an example, 30% of inflation, let's measure it based off of CPI, is based off of housing. And housing based on the CPI measure of it right now, or the Zillow measure of it right now, which is sometimes seen as a little bit more of a current measure of inflation, there's a 500 basis point spread between those two. Zillow inflation is showing 1%, CPI inflation is showing 6%. So if those two were to converge, that's a lot of disinflation still in the pipeline. So maybe that's something that the credit market is, trying to let us know with pricing in 140 basis points of cuts.
Okay. Well, but obviously the loosening in financial conditions has caused mortgage rates, for example, to come down from their peak. Do you think that could sort of offset the disinflationary pressures that we have also seen to some extent in the housing sector?
That is always the risk of loosening financial conditions when you don't want them to loosen, because if economic activity was slowing because of tighter financial conditions, logically, then economic activity should pick up due to looser financial conditions. It's just a simple equation over there. So obviously, we could be in a world where you could have some sort of resurgence in inflation. But given the fact that there is still so much disinflation, we think still in the pipeline, and given the fact that the overall trend in the labor market is downward, although it's a little bit slower than a textbook would have suggested, we think that it's still more likely than not that we get continued disinflation rather than a resurgence in inflation.
Okay, absolutely. And maybe lastly about this topic with the 10-year yield, I think it's above 4% again today. Also, of course, in response to this labor market report, maybe that kept the 10-year yield a bit higher. Do you think a 10-year yield of, let's say, between 4 and 4.1% is attractive to buy at the moment?
I would personally say, given where we are at the cycle, especially due to the fact that regardless of whether the Fed is cutting by 75 basis points or 150 basis points, it is going to be cutting. We would think that putting on a 2-10 steepener trade is probably better than just straight up owning the 10-year bond. Right now, the curve is negative 35 basis points inverted. Last time the Federal Reserve went on a cutting cycle in 2020 or in 2019, the yield curve normalizes between 100 and 200 basis points. So that would imply 150 to 250 basis points from current levels worth of normalization in the yield curve. And we just think that's a much better trade in terms of risk reward than just straight up owning the 10-year. If you were going to be in the 10-year, again, I would probably point towards that tip, the 10-year tip. Given the fact that it's 1.8, I don't think a 1.8% 10-year is so sustainable. I think it'll settle somewhere around 1%. So there's a lot more appreciation in the 10-year inflation-linked bond potentially than there might be in the nominal bond. So that would be my answer in the debt space.
Okay, yeah, it's incredible when you think of the 2s10s curve, for example, that it used to be inverted by I think 100 basis points back in 2022, and so quickly we were back at 30.
Silicon Valley crisis, the Silicon Valley Bank crisis. It was north of 100 basis points in March of 2023. That was 10 months ago.
Yeah, the shift in narrative is certainly incredible also in the last 2 months of 2023. Okay, so let's move on to our second topic, talk a little bit about gold. And I think kind of connecting that to the question of real yields, is there a correlation between gold and real yields?
There's a very significant correlation, but it's an inverse correlation, which means that as real yields fall, the price of gold tends to rise. And that's natural. Gold is a non-interest-bearing asset or currency or metal, however you want to think about it. Obviously, a real yield is a promise from the US government above the rate of inflation, which means that it's going to be growing above your erosion and purchasing power due to inflation. And obviously, as real yields fall, inflation-linked bonds become less attractive, and alternative investments that have no yield but have different types of protection measures become more attractive in that background. Gold is one of the most sensitive assets to falling real yields. Also, you can also look at it as gold is a protection against hard times, and a falling real yield to an extent indicates that we are going upon hard times. If the economy can stay strong, a real yield can sustain itself. But if an economy begins to weaken, historically real yields have to compress to accommodate for the new economic reality. So we certainly believe that gold is something worth holding onto as we begin this rate cutting cycle.
Okay. Well, if that's the case, do you consider gold to be a good hedge against inflation? Because obviously, if inflation is higher, that means that real yields are lower. But on the other hand, higher inflation will mean that the Fed might hike interest rates again, causing real yields to potentially rise. So do you think it's a good hedge against inflation? at
We
this
might have a little bit
stage of the
contrarian
cycle?
take here. We think that gold is a great hedge against inflation before policymakers begin to respond to the inflation. So if you look at 2021, gold was up on the year. If you look at 2022, when the Federal Reserve began to respond to the inflation that started appearing in the back half of 2021, gold went nowhere. It was flat. That doesn't make it a bad investment, but that didn't mean it, it didn't keep up purchasing power with the 8% or 9% inflation that we experienced that year. Also, if you look back at the last, major episode of inflation in the West, let's take the 1970s in the United States as an example. In the first half of the 1970s decade, the first 5 years, gold appreciated significantly more than in the back half and in the beginning of the 80s, as especially in 79, 80, 81, when Chairman Volcker came in and really raised rates up. And so, there again, we believe that gold does a lot better when there is an inflationary bias in the environment, but policymakers are not yet responding to that inflation.
Okay. So does it matter why the Fed cuts interest rates for gold? Because let's say it cuts interest rates because of a recession, that will obviously push real yields lower. But if it cuts rates because of a soft landing, let's say, for example, would that lead to the same effect of a decline in real yields on gold? Because in the soft landing, of course, we're not in that peculiar situation where you would look for safety as an investor.
Obviously, the hard landing, the 150 basis point cut scenario, that would be the scenario where gold would benefit a lot more, because it will not only get that compression in real yields and also a bigger compression, but it will get those safe haven bids, as you said. But nonetheless, even in that soft landing scenario, just the compression in real yields alone probably would suffice to, cause some appreciation in the price of gold in the new year. So like you said, it would probably be, more beneficial for gold if we were in a hard landing, but we wouldn't expect a loss necessarily in gold in a soft landing scenario either.
Okay, so it seems to be a good investment these days in this environment of macroeconomic uncertainty.
We've been wrong before. We'll see.
We'll see, yeah. Okay, moving on to the third topic, artificial intelligence and earnings. Of course, everybody that follows the markets knows that NVIDIA, for example, surged significantly last year because of this hype around artificial intelligence. But that has, to a large extent, that has been driven by valuations, multiple expansion. So obviously that E of the PE ratio has to follow at some point. So how do you think will AI impact earnings in 2024, and will it live up to its expectations?
So for this topic, if you don't mind, I'll talk more broadly about the sector rather than any one individual company. It's not my expertise, but I can talk about the overall sector, not NVIDIA, not any specific company, but there could potentially be the risk that market has pre-priced in as a fact that AI is going to lead to productivity gains, to corporate earnings growth, to lower marginal costs for companies, a myriad of tailwinds. And that's been sort of priced in already. If you look at the last time the 10-year traded at 4%, the PE ratio on the NASDAQ 100 was nowhere near where it is now. So that obviously indicates to us that a significant growth in earnings is anticipated in the market at some point, and that could totally end up being right. Where the risk we think might lie is, what if the benefits of AI cannot materialize either as fast or to the extent that markets are anticipating? Or alternatively, what if the benefits are concentrated in a few companies? What if NVIDIA is gaining all of the economic benefit? Or what if, a parallel company to NVIDIA is gaining all the market benefit, where a company like, as an example, Micron may not be getting the same exact level of benefit to its economics from, AI. So it's just something that we are cognizant of. We recognize that equities, all other things equal, could be a little bit overvalued. However, we don't think they're overvalued because We personally do believe in the AI story. We believe that this will lead to tremendous tailwinds for corporates, and it will lead to new innovations that we cannot see yet. I mean, that is sort of the history of technology. One innovation leads to another innovation that couldn't have been there without the first innovation, but that the people that created the first innovation really couldn't have seen that second innovation coming. So, as an example, could mobile e-commerce have been possible without the telephone? No. But would anyone who have created the telephone think that they would have been disrupting the brick and mortar industry at the start? Probably not. So for that reason, we will stay long equities. We'll almost always stay long equities because over time, the single most significant thing that causes economic growth, productivity growth, human growth is humankind's inventiveness and our ability to grow and adapt and become more efficient over time. So in terms of participating in the equity market, we will continue.
Okay. And maybe considering the short term a little more, I think it's great to think of all the productivity gains that we can potentially see because of AI. I'm very excited about it. But sort of talking about it, looking at the short term, because the rally we have seen has been driven by those Magnificent Seven so much, and because of that AI hype, do you think that in 2024, if we don't see it materialize, do you think that that could put significant pressure on the broader market, on the S&P 500, for example, if we don't see those AI benefits as soon as in 2024, for example?
You know, we never try and time the market when the market is going to respond to anything. Obviously, at some point, absolutely, if AI does not materialize, of course, equities have to reprice. Of course, those 2025, 2026, 2027, whenever it may be, those earnings have to be revised back down. Maybe that could also be incurred by a recession. Maybe a recession leads to less R&D into AI technologies, and that hinders the progress. You know, there's a lot of different ways that that type of story could, could play out. But in any event, we think that as long as you can be diversified across the asset classes, which will be one of my points later on, but as long as you can be diversified, it is a bet worth putting on to participate in equity markets because over time they tend to go up.
Absolutely. Okay, thank you very much. I think we can move on to topic 4, US-China relations, and specifically also to some extent the election in Taiwan and US this year. My first question would be, we're going to see a significant issuance of treasuries in 2024. I think it's up 25% compared to the previous year across the yield curve. How do you think could China-US relations impact the demand for treasuries from China? Because China is obviously a big buyer of US treasuries.
So let's take a step back here, just, give the listeners some history here. Since China joined the WTO in 2001, the US-Chinese relationship has been the most important relationship in the entire world, economically, socially, foreign policy-wise, politically, militarily, however you want to consider it. It's been the most important relationship in the world. US consumers and US businesses wanted cheaper goods and a cheaper cost of manufacturing. China wanted to become an economic powerhouse, largely on the vision of Deng Xiaoping. And this relationship was formed. And what ended up happening was that China manufactured goods for the US bought, China had this excess dollar reserve that it now built up from all of these, manufacturing sales. And what did it do with it? It went and it lent it back to the United States in the form of owning treasury bills, bonds, notes, whatever it may have been. It lent the US government money back. And this did a couple of things. The first obvious thing is that it gave China a safe and liquid reserve that it could hold onto, the safest in the world, the US dollar. But on top of that, this, by buying so many treasuries in the United States, this suppressed yields in the United States and it allowed the US government, US corporates, US households, US individuals to borrow at lower rates. And as households borrowed at lower rates, they were able to sustain their spending via financing it at really low rates. And, China wasn't the only reason this happened. Of course, There was 2008 financial crisis. There was a Federal Reserve intervention. There was QE. There was zero interest rate policy. There was a lot of things. But China was one of the reasons why this had happened. And with this newfound credit that US businesses and consumers had, they went and bought more goods from China. And this led to a self-sustaining cycle. And one second order effect of this, if you really think about it, is that by lowering bond yields in the United States, investors were pushed out the risk curve. 2009, 2019 was one of the best rallies in equity market history. Alternatives like Bitcoin showed up. Could something like Bitcoin have shown up in a world where there was 4% 10-year rates in that decade? Who knows? Maybe they could have, maybe they couldn't have. But this relationship was far and away the most important for the world economy in the last, let's call it 15, 16 years. Now, if that relationship were to come to some type of slowdown or a screeching halt, a lot of what we've come to become accustomed to would have to be reconsidered. A lower cost of manufacturing, lower US bond yields, lower mortgage rates, higher asset prices. All of these things, to an extent, would have to be reconsidered in the event of some type of divorce between the US and China. And obviously, the elephant in the room, the most significant immediate risk, or not immediate, but the most significant obvious risk, I should say, would be some type of armed conflict between Taiwan and China. Bloomberg just ran a simulation on it that showed that in the event of a naval blockade by China of Taiwan, it would lead to a 40% contraction in year one in Taiwan's GDP, about a 16% contraction in China's GDP, largely due to sanctions that we would assume the West would put on, and about a 6% contraction on the US's GDP due to the fact that we would really not be able to get those semiconductors from Taiwan and get at a cheap price everything else that we're buying from China. So we are not dependent, but we are business partners with both of these countries, whether we like it or not, for the time being, and we have to consider these risks.
Okay, yeah, that was incredibly insightful, because when you, I don't know, go back to that time when we had 0% interest rates, I mean, people they tried to find some yield in the markets. So maybe you could consider that that's somehow led to Bitcoin, for example, as you touched upon. But it's, yeah, I never thought about the fact that China really helped yields to remain at such a low level for such a long time. So what you're saying is, if those relations, let's say, become worse in 2024, that lack of demand from China, in addition to the additional supply of treasuries in 2024, could really potentially push up yields. And I mean, that would have put some downward pressure on equities.
Well, I mean, we would have to be realistic. US debt is 34 trillion. China owns about 1 trillion of US Treasury. So they own roughly 3% of the market. As an example, the Fed's balance sheet in the last year has contracted by 1.5 trillion. So, I mean, the Federal Reserve's balance sheet has contracted in the last year and a half by more than China's total Treasury holdings. So, and sometimes it tends to be a little bit maybe overstated, but it's just something to be cognizant of. Will it push up nominal yields or real yields? It certainly could. But we would on that case, we would think, as an example, Dallas Fed President Logan said over the weekend that the Fed is going to consider when to slow down QT, or possibly when to, just stop it altogether, maybe. That would be the type of thing that we would think would be a bigger tailwind to lowering Treasury yields than maybe lower demand from China would be a headwind. But it remains to be seen. We'll monitor it closely.
Okay, absolutely. And in general, I mean, there's a lot of uncertainty regarding US-China relations. How do you think that could impact all of these geopolitical risks? How could that impact investor sentiment in 2024?
Of course, this is a year that's going to be marked by an election this upcoming Saturday in Taiwan, and then in November in the United States. So there's always going to be changes in risk sentiment around elections. They are consequential. On the other end, we believe that companies should be getting prepared for contingency plans. Not that anything is imminent regarding China and Taiwan, but as we saw when Russia invaded Ukraine, that you don't want to be caught flat-footed in that type of environment. There cannot be a scenario where Apple is 100% relying on manufacturing in Shenzhen for the iPhone. It needs to move manufacturing, whether it be to India, to Vietnam, wherever it could be, to an extent to mitigate against those risks. Even if they are tail risks, these are things that companies have to be cognizant of. It's not something that you can let go to the last second and then try and scramble and create a solution. This is way too big of a marriage for it to be a clean divorce. It just can't.
Yeah, I mean, the U.S. economy and China's economy have become highly integrated to some extent. Yeah, absolutely. Okay, lastly, let's talk a little bit about the diversification. I'm very excited about this because if you go back to 2023, I mean, obviously small caps did not perform very well. And then in November and December, you saw that significant decline in the 10-year Treasury yield from, I don't know, 5% to I think 3.8%. And then that is when small caps, mid caps outperformed. So what do you think is the relationship between interest rates and small caps? Do you think small caps are much more sensitive to interest rates?
Absolutely. I mean, if you look at the Russell 3000, the small cap Russell, the Russell 2000, I should say, every 50% of that index has floating interest rate exposure, compared to about 7% for the S&P 500. So, I mean, just think about that. A 100 basis point drop in interest rates on floating debt could really rise adjusted earnings for a year. That has to be priced in. On the other end, small caps have a much shorter maturity wall. So small caps have a lot of debt coming up that has to be refinanced, termed out, or retired in the next couple of years. Versus the S&P 500, the majority of it is termed out past 2030. So they've been insulated from this rise in interest rates, just like how people that bought a house with a 2% mortgage on it have been insulated from 7% mortgage rates. So of course, small caps are more sensitive to interest rates, and this works in both directions. This works as a tailwind when interest rates are falling, and it works as a headwind when interest rates are rising.
Absolutely. So do you think from this, as if we do get a soft landing where obviously interest rates would fall, do you think small caps are the sector that could benefit the most from that soft landing?
If there were to be a soft landing and economic activity then sustained to an extent, and corporate earnings can either grow or at the worst remain flat or slightly decline, we believe that is a type of environment where small caps could outperform large caps. Now flip that equation. Let's say we get a hard landing. And small caps are also a lot more exposed to economic conditions. So if we were to get a hard landing and corporate profits were to fall, let's say 25%, which is a standard recession, that would be the type of environment where you could reasonably expect small caps to be hit a lot harder than large caps would be hit. So given that, I mean, I think there's a diversification component that should be had in there. But beyond that, I think diversification really, at its core, is about diversifying across different asset classes. So, a loss in your equities should be offset by a gain somewhere else, whether it could be your treasury book or your gold book, or as an example, a loss on your bond book should be, offset by a gain in your commodity, in your oil book, or whatever it might be. That's what I really mean when I say diversification, rather than necessarily small caps or large caps.
Okay, so lastly, I would like to ask you about the 60-40 portfolio, because in 2023, we saw a very strong correlation between the 10-year yield and equities. So in bonds in general and equities, treasuries and equities. So when treasuries were rallying, equities were rallying, because obviously that put downward pressure on yields. Do you think, given that we saw that correlation, that could pose challenges for the efficacy of the 60-40 portfolio in 2024?
course, of course. I mean, granted, it worked towards the end of the year in a beneficial way, but at its core, the issue with the 60-40 is that if and when equities and fixed income become positively correlated, there is no diversification benefit of that portfolio. Now, generally speaking, the correlation in those portfolios happens, the negative, when the correlation is not working for us, happens in a rising inflation environment. That is the reason why we believe you have to maintain exposure to commodities like oil and gas. You have to maintain exposure to gold. You have to maintain exposure to maybe the US dollar versus some, central banks that are a little bit more lenient, like the Bank of China, Bank of Japan, I'm so sorry. So you might put on a US dollar yen short. But this is the exact reason why, and the past couple of years have perfectly illustrated why a 60-40 portfolio, while yes, it may be better than just a straight equity portfolio, it is not sufficiently diversified. It is not nearly sufficiently diversified. And also, that's not even speaking about the fact that a 60% allocation to equities is probably a little bit too high, given the embedded volatility in equities and given the fact that corporates are leveraged, which means that you are indirectly getting leverage in your 60-40 portfolio on the equity side. So that your 60% exposure in terms of risk, about 95% of your risk in a 60-40 portfolio is concentrated in equities. Yeah. There's almost no diversification there.
Mm-hmm. And then if you look, I don't know, to the end of this year or throughout 2024, what do you think could break that correlation between the 10-year yield and equities? Would it be a hard landing?
Absolutely. I mean, the thing that would most closely, most acutely break, or just bring back the negative historical correlation between equities and fixed income would be a recession. It would be something where bond yields are falling, aka bond prices are rising, where at the same time, equity prices are falling. Q1 of 2020, 2008, that would be the type of environment in which we would expect, the correlation to go back to its normal standard.
Mm-hmm. So that correlation to a large extent was driven by that soft landing narrative.
Sure.
Okay.
Yeah, I think so.
All right. Well, I have one more question about the recently released economic data, if that's okay. If you take a look at the labor market report, for example, the 10-year Treasury yield, it rose slightly after the report. It then came down again. Then, of course, we got that ISM report. How do you interpret that labor market report?
Interpret it is that the economy is slowing, demand for labor is slowing. Had labor force participation stayed the same, the unemployment rate would have risen in that report. Mm-hmm. So again, this is a long process. This is not going to happen, in a short amount of time. This is also why we don't want to time the market, because there are going to be blips. But we nonetheless believe the overall trend is negative, and we believe that eventually we are going to have payrolls under 100K and possibly even a negative payroll print. At that point, I think it would be safe to assume we're in a recession.
Okay, absolutely. And I mean, wage growth, I think, was a problem in that report for the Fed.
About 0.4% monthly, so almost 5% annualized, which is a little bit of an issue. You're right.
So do you think in order for the Fed to be confident that inflation is on a sustainable trajectory to the 2% target, you would have to see wage growth come down before the Fed will cut interest rates?
I mean, Chairman Powell has alluded to the fact that, they want to see wage growing at an annualized pace between 3 and 4. Mm-hmm. And I think that could happen. I think that more important than possibly the wage growth number is I think they would want to, they're going to wait to see prints go a little bit lower. 100,000 jobs added per month is what we need as a country. The US needs as a country, just for population growth and retirements. So anything below that, I think it's safe to say we're going to be cutting imminently once that happens.
Okay, and maybe for our last question today, I know you said you don't want to time the market, but the markets are currently betting on, I don't know, around a 60% chance, I think, of a rate cut as soon as in March. How likely do you personally think is a rate cut from the Fed as soon as in March? Is that now a likely outcome?
I think we're gonna have to wait on a couple things. We're gonna have to wait for fourth quarter earnings. I think that is a little bit more important than is assumed. And I think based on how fourth quarter earnings come out, companies may begin to adjust headcount, whatever it may be. There are a lot of things I think remain to be seen. That's going to be a live meeting for sure. And you know, a live meeting basically means that they could cut, maintain, or raise at that meeting. I can answer that question maybe in a month, probably a little more accurately. I think by May we get a cut. I think March right now maybe is a little bit premature, but if things take a tail for the worse, it could totally happen. It wouldn't stun me. It wouldn't. I wouldn't, you know, bet with conviction on it, but it would not stun me either if it did happen.
Well, I guess we're getting a hint this week from the inflation report.
Absolutely, absolutely. And also we have bank earnings coming up on Friday morning, which are important.
Exciting times. Well, 2023 was an incredible year with the soft landing narrative. Let's see if it can continue in 2024. Thank you very much, Mr.
Thank you,
Hakimian.
Elias. Thank you
for your
time.
time. It was a great interview. Thank you.
Appreciate it. Bye.